Welcome back. This is Benny Victory, Reverse Mortgage Professional. It's post-Thanksgiving and I'm in the office because I wanted to make a video to answer a comment that I received from a viewer, a gentleman that saw the video that I made right prior to Thanksgiving. In that video, I said that in order for the right decision to be made regarding reverse mortgages, there has to be a conscious and active, a deliberate decision made by seniors based on the available research information and the significant amount of data that we have on this topic, and to be able to make that decision not out of a reflex or a knee-jerk reaction, if you will, to the idea of a reverse mortgage. Some people automatically dismiss the concept of a reverse mortgage without even looking at the data, without looking at the research, without looking at the documentation. And when I received this gentleman's comment, I replied back that I'm going to answer his concerns that he raised in a video. And the reason I did that is because I think that his concerns are reflective of some other people that may have the same issue. And if I could address this topic, not only is it good for the viewer who had the concern, but for all the other people that are interested in this topic but may summarily dismiss the idea of what the reverse mortgage can do and how it can benefit them, and not look further into it. So it seemed like a perfect setup post that interview to be able to discuss the concerns that this gentleman raised up. Now, something you should know about these videos, I have them in basically format idea in my mind about what it is that I want to cover, and from start to finish they're done in one take. I don't edit, I don't go back and add, and it's just too complicated for me and I don't have the time to be able to do it. So forgive me when I have to read from my notes or to be able to reflect on something that I show. It's done in the spur of the moment, and to be able to just put the finished product out. So forgive me on that. So I want to read the comment that I received, and then to me it basically summarizes in 3 points, which I will do by discussing each one and break it down and go in deep detail. The gentleman wrote that it's a negative amortization loan. You owe more every month. That's his first point. It's a negative amortization loan and that you owe more every month. The second point he raises is that you wouldn't be taking the mortgage if you had cash to pay for it, so it's guaranteed destruction of equity in the home. So the second point seems to be that it's really an unnecessary loan, and kind of, if you had the money, why would you do this? And it's a guaranteed way to destroy the equity in the loan. The other point seems to be that they, meaning the lender, calculate the loan to eat all of the equity and appreciation of the property, and there's no exit other than selling the home and being left broke. So the lender calculates the loan to eat all of the equity and appreciation of the property, and there's no other way other than selling and being left broke. So when I read that, I certainly wouldn't want someone that I care about or a senior to get into a loan that has such a negative connotation for it. But this is the perfect example in my mind to discuss what we talked about, or what I talked about in the prior video, which is, if you think of this mortgage, if you think of the reverse mortgage product in this light, of course you're never going to consider it as an alternative or a viable option towards your retirement, which is why I stress the point that at this point the loan is 34 years old, and in the last 10 years the amount of information, the amount of peer-reviewed data, the amount of research, the amount of white paper that we have on this topic is so significant that to dismiss it is, for lack of a better word, being negligent, whether by financial advisor or whether by the senior themselves. Obviously, it's your decision whether you want to take it or not, But if you choose not to take it, it's not because it's a bad product. It's an ill-conceived product. It's a destructive product. If you choose not to take it, you do so at your own peril, and you do so disregarding the amount of information that we have. So now I want to kind of set up each point and go over it because I think each point merits its own discussion. And at this point, I've done 35 videos. So some of the videos that I have done touch about different points of the conversation that we're having today. But I think this is important to bring everything together at one place at one time. And I would say that this video, by the time it's done, is going to be a very important and overall significant video that brings all the pieces together, especially if the same concern that this gentleman has is what you have. So the first point that was raised is that it's a negative amortization loan and you owe more every month. Okay, so let's start off with that. What is amortization? Amortization is a schedule payment of, depending on what your contract is for, of typically principal and interest over a certain period of time. As it relates to mortgages, amortized schedules can run depending on the type of loan that you get and the number of years that you get it for. We want to keep things basic and simple and kind of in line with what most seniors have. So in a prior video that I did, which was entitled, Why You Don't Make a Payment with a Reverse Mortgage, or Why Is There No Payment Required on a Reverse Mortgage, which is in the playlist of my videos. And in order to be keeping continuity with the information that I provided in that video, I'm using the same numbers in this video. Even though right now in November 2022, we have had a series of Fed interest rate hikes, which have basically pushed the forward mortgage, the traditional mortgage that people get on a mortgage, to as high as 7.5%. So the numbers that I used for that example don't even exist anymore. But for the point of making the argument, and again being congruent with my other video, I'm going to keep it and you'll get the idea. So if on a forward mortgage you were to get a $300,000 loan amount at a rate of 3.75, which is amortized over 30 years, and that all that means is that you're going to have 30 years to pay off the loan, you would have had a payment of principal and interest of $1,389. Off that $1,389, if you looked into that payment, the payment would have consisted of $937 of interest and $451 of principal. So here we have, assuming that you don't refinance this loan and you take this loan from start to finish, you never refinance it, and if you look at the payment pattern, you're starting with $300,000. Here's year 10, here's year 20, here's 30 years. By the year you finish the 30th year on this loan at 3.75, which is not a significantly higher rate and it's not rock bottom, if somebody would have told you on this $300,000, you would have paid a total of $200,000 interest. That's on top of paying off the $300,000. I don't know if you would have figured that out up front and you would have accepted it. In other words, it cost me $200,000 to borrow $300,000. So when we're talking about paying interest, and this comment is it's negatively amortized, what does that mean? Well, on a forward mortgage, your interest is calculated into the payment and included. You just don't realize that how much of it is being paid off, and partly that's because of the fact that all along the way, when property values come up and interest rates come down, you refinance the loan again and again and again, and each time you extend it out. So you as a borrower yourself, as a senior, having had a house for 20 or more years, you could look back and seen in your own personal record how many times you've refinanced a loan, how many times you took more money out, extended it from year number 1 when you were 5 years, 10 years into it. And each time you understand that when you increased your balance and the rate changed and you started from 0, accumulatively you paid more interest than you would have if you had just finished everything. But if you don't ever refinance, on that $300,000 debt, you pay $200,000 of interest. And no one seems to take objection to that because that's just part of doing business. Now, when it comes to the idea of doing a reverse mortgage, another thing that people take and paint with a broad brush is that they think all reverse mortgage and all reverse mortgage borrowers are the same. And they're not. And the reason they're not is because if you conceptually understand that there are 3 distinct types of borrowers, then you also understand that the amount of negative interest that's being accumulated is completely different for each one of these individuals. So what do I mean by 3 types of borrowers? Well, very simple. You have one group of people, one group of seniors that own their property free and clear. If you own your property free and clear right now and you wanted to get a reverse mortgage, why would you do that? Well, you would do that because you want to have a standby line of credit in place so that when you want to use it, it's available for you and you could just go ahead and take the money out. Now, why would you want to do that? Why would you want to have a standby line of credit? Well, the reason you want to have a standby line of credit is because compared to a home equity line of credit, which is a HELOC, which is what you get in a traditional mortgage, which is what you've gotten before, the features and benefits of a reverse mortgage line of credit work completely different. First of all, they provide you with protection of what the property value is today, and they lock in that high value so that in the future, if the property value goes down, the bank doesn't come back and say, well, listen, we need to review whether you're eligible to get the line of credit because property values have depreciated by 20 or 30%, which is what happened in 2008 to 2012. Another point that you want to get a reverse mortgage line of credit is simply because of the fact that a reverse mortgage line of credit can grow and increase over time and give you more borrowing power. So if I have a line of credit put in place today and I don't need to use it for 3 to 5 years, that line of credit that I'm going to have in 3 to 5 years is going to be considerably higher and larger than what it originally was set for. Another key point with getting a reverse mortgage line of credit as a standby line of credit is the fact that unlike the traditional HELOC, the lender cannot close or reduce or freeze a reverse mortgage line of credit, which if you think about it, if you need this money and it's suddenly taken away from you, now you might be in a difficult situation. Obviously, the biggest difference is that on a reverse mortgage line of credit, you don't have to pay the monthly payments if you don't want to. You always can. You could pay a minimum payment, but you don't have to. Another benefit of a reverse mortgage line of credit is that unlike a HELOC, where you only have a 10-year interest-only payment option, and then after that you have to pay 15 years of principal and payment to completely pay off the loan, with a reverse mortgage line of credit, you could pay as much as you want or as little as you want or nothing at all. Okay? And if you look at side by side, which again, I've done a video which compares the side by side comparison of a HELOC compared to a reverse mortgage line of credit, that affords a substantial amount of flexibility to the senior who is on a fixed income. And that's the point you need to keep coming back to when you start to compare between a reverse mortgage line of credit or a reverse mortgage product and a traditional product. It's a different conversation. It's a different criteria. And if you don't have that right frame of mind when you go into the reverse mortgage and you're expecting to have all the same things that you used to have with a traditional mortgage, you're going to be disappointed and you're going to have a poor view of the program. This program is designed and intended for seniors to be able to access a portion of their home equity. And that home equity is what's supposed to supplement their individual retirement, whether it's through a Social Security and a pension, and through the use of the reverse mortgage, whether it's through a reallocation of the payment or being able to use the line of credit. They're able to have some flexibility in how they structure the retirement, okay? And if you don't see it that way, and if you go into it and thinking that, oh my God, you know, this loan, I'm going to have so much negative amortization, then how do you dismiss paying $200,000 in interest when you borrowed $300,000? This wasn't a situation where it was free. You had to pay interest. Of course the bank is expecting interest. Now, if you want to make the monthly payment and choose to pay the interest on a reverse mortgage, nobody's stopping you. You're welcome to do it. Would I suggest it? On a case-by-case basis, with conjunction with what the benefit of it to you is, maybe that's a conversation to be had. But wouldn't you rather have the flexibility to not have to make that payment? Think about it. If you're on a fixed income, you and your spouse are on a fixed income, and if you had to make a $1,389 payment, and this is only on $300,000, there's loan amounts that are higher than that, and obviously there's interest amounts that are higher than that. If you could save $1,389 by not paying it, and you use this money to pay for something else, paying for your property taxes, paying for your medical needs, paying for your long-term care needs, paying for whatever it is that you need, the bottom line is you can pivot and you could use this money for something else. And that's an option available for you. Is that a bad feature? Is that something to look at and say, oh my God, this just is bad? It's not bad. It's flexibility. But if you come into it with a frame of mind which is, this is the wrong thing and my interest is being added on, then you're not going to be thinking about this program for the way it is. You got to understand, this program is 34 years old now. The program was intended for seniors to have access to a portion of their equity. And I'm going to keep coming back to that because who put this together? It was the United States government. It was HUD, Housing and Urban Development, and it's being administered through the FHA, Federal Housing Administration. It's not put out by the bank because it's going to make the bank more money. Is the bank interested in making money? 100%. Is the bank going to make money? 100%. But guess what? They're able to make money over here by charging you interest the same way. And when I'm done with this whole overall conversation, you'll understand that actually, more likely, you're going to have less interest accrued on a reverse mortgage than you will on a traditional mortgage. And the answer is very simple. It's longevity. Chances of you living long enough, 30 years to stay in this house, to accumulate that much negative interest is less likely. Not, God forbid, because you're going to pass away, but realistically because you're going to need a situation where you need more in-home care, and that cost is going to be prohibitive because you're going to be not in a situation where staying in that house is going to be feasible for you because it's not safe, because there's a second story, because there's going to be major remodeling expenses that you need in order to be able to stay in that house. So the options become now, maybe you need to go into a care facility, maybe you need to go to an assisted living facility. And if you only have this mortgage, the reverse mortgage, for 5, 6, 7 years, and you understand how the program works, how can you accumulate as much interest as you would on a traditional forward mortgage that you've had for up to 30 years? So, but I'm getting ahead of myself, but I want you to kind of get the big picture and see where we're going. So back to this understanding of the fact that this gentleman has a problem with the negative amortization loan and you're going to owe every month. We already established in the forward mortgage, you're going to owe interest, and because you've kept on repeatedly refinancing, you just don't realize how much you've accumulated. Now, what I started off with saying is that there's 3 types of reverse mortgage borrowers. The first type is the kind that gets the standby line of credit in place so that when they need it, it's available. A second type of borrower is that borrower that has a small amount owed on their existing mortgage, and once we determine that we could get them a reverse mortgage, we're going to pay off their existing line of credit or their existing mortgage. And this is what that scenario would look like. So in the first type is the property is free and clear. The second type, let's say they owe $200,000 and they can get a reverse mortgage for $350,000. Well, automatically we're going to pay off the $200,000 that they owe on their existing mortgage. And what else are we going to do? We're going to make available for them a line of credit for $150,000. Now, this line of credit that's available is going to have exactly all the other features and benefits that I shared with you on the first client, which is going to have the standby line of credit. Again, this is the same line of credit. It's on a standby basis. You let it sit. You don't need to use it. Don't use it. But on their existing balance that we paid off, this $200,000, now they don't have a mortgage payment. It's the same scenario as up here. Now, obviously, the numbers are going to be different, but again, the same conversation becomes when we pay off your mortgage, you now don't have to pay this amount. And if you can redirect this payment to go towards something else, is that better for you? Is that more beneficial for you? Is that going to give you more flexibility and more cash flow? If it is, great. And if you want to make an interest-only payment, you're welcome to do it. If you have to, again, it's on a case-by-case basis. I don't know why you would, but maybe you just have to. Okay, do it. Third scenario. This is the borrower that, let's say, has a higher balance. Let's say this person has $400,000. And when we do the numbers based on the criteria of what their property value is, the age of the youngest borrower, the interest rate, we determine that we can have only enough money to pay off their current balance, which is what we'll do. We'll just come in with the reverse mortgage. There's going to be no line of credit because they basically have enough money to go in and pay off this $400,000 existing mortgage through Wells Fargo, through somebody else. Again, does that person benefit? Yeah, absolutely, because now they're going to get rid of their monthly mortgage payment to be able to use it to something else. Now, collectively, this goes back to this idea of the overall accumulated interest being less potentially than what you do in a forward mortgage, and the reason for it, we just established that there's three criteria. There's three different types of seniors. There's three different potentiality of the use of the reverse mortgage. Which one are you? Are you the individual that is going to have the property free and clear and we're going to give you a standby line of credit? Are you going to be the gentleman that is going to have $200,000 and you're going to have an available line of credit and we're going to pay this? Or are you going to be the family that comes in, the husband and wife that pays off the reverse mortgage, pays off their mortgage, and that's that? That's one category. Which one of these three are you? Now, the other consideration is, here's time. Starting at 62 on a home equity HELOC, that's the HELOC, the HECM, home equity conversion mortgage, which is the technical name for reverse mortgage. It's a home equity conversion mortgage. And if you think about it, it makes perfect sense. It's your home, it has built-in equity, we're converting it and we're making it into a mortgage, a HECM. But few people go around calling it a HECM, we call it a reverse mortgage. Well, we know that for the FHA insured program, the starting age of the youngest borrower, of the most eligible borrower, is 62, because you can have a husband and wife, for example, where the husband is 62 and the wife is 58. But because at least one borrower is 62, they qualify. So starting at 62 and going forward is when you're eligible to qualify for the HECM. There's a private program, there's a jumbo program that the starting age for that is 55. And that's the reason I distinguish, because there are some people that starting at 55 can qualify for also a reverse mortgage, but that's a different guideline, different pricing, different numbers. 95% of the mortgages that are issued are the home equity conversion mortgage, which is what we're talking about here. So now we've established that there's three classes of individuals and 3 types of people based on their financial needs and their situation that can get a reverse mortgage. Well, the other consideration now becomes, well, how old are you when you get the reverse mortgage? Not everybody, as soon as they're 62 and can qualify a reverse mortgage, runs out and gets it. There's plenty of people that I speak to that are 75 or 70 years old. Okay, so you have to now determine what is the age of the person that is getting the mortgage. Because why does that matter? Well, this is your runway. You're starting from 62 and I'm all the way up to 95. To me, 95 is a solid age where you could still age in place depending on how good you are and what your needs are. But again, that's a case-by-case basis. But I want to establish the runway here so that you understand what we're talking about. So if you have a person coming in at age 70 and gets the reverse mortgage, and let's say of these 3, he's in the second class. He's the one that has a $200,000 mortgage that we paid off, and we gave him a $350,000 mortgage, and now after paying off his $200,000, he has $150,000. Okay, so when you look at this person, guess what? He's 75 now. We got the loan for him at 75. Well, when you are at 75 and you owe $200,000, from 75 to 95, there's a 20-year lifespan. Now the question is this borrower going to be a borrower that can potentially stay in his house for the next 20 years? Don't know. Is it more likely that he's going to stay in his house or be alive or be able to be in a position that it's beneficial for him to stay in the house for the next 10 years? Probably more likely. Okay, so what happens now? Well, if we start here at $200,000, the loan, the amortized payment, the amount of negative or the interest that's going to be added on there, it's not going to shoot up overnight to $100,000. What's going to happen? The loan is going to have a trajectory that's like this. Just like this took 30 years to come down, the amount of time that this is going to take, the amount of time that it takes for that interest to build up, which is the negative interest that the gentleman is referring to, is going to be over an extended period of time. Now, if this person is only in this house for 10 years in my example, how much negative interest do you think is going to be added, assuming they don't even make a single payment, and the housing values, whether they go up or they go down, because everything is not in a vacuum, everything works together. So if this person is only staying in the house for 10 years and they haven't made a payment, how much do you think that they're going to owe in amount of interest accrued that's going to eat up all of their equity? You get the point? Now, if this person gets it sooner at 65, now, again, depending on their health, depending on their payment, depending on whether they start off at 0, whether they start off with some balance, whether they start here at a higher amount, the concept is the same. The concept has to do with, depending on which one of these 3 borrowers you are, you're going to have a glide path that, depending on your age, is going to be going very slowly. It's like this. It's not like this. And because it just doesn't shoot up, this impression that the gentleman has that I'm going to lose all of my equity, purely not present, because it doesn't shoot up overnight. So when it comes to this concept of the negative amortization you're going to owe every month, I think I pretty much covered it so that looking at this situation, you understand that that's not the case. So the second point I want to raise is that the objection seems to be that you wouldn't be taking this mortgage if you had cash to pay for it. So here, this gentleman is referring to of all the options available, this seems to be the worst in his mind. And this is exactly on point to my other video that I made, which is, at this point, we have 10 years of what the reverse mortgage is, its benefits, its features, and its role in retirement. In specific, I said that the gold standard with financial advisors is the CFP designation, Certified Financial Planners. And the American College puts out and educates more certified financial planners than any other college doing this. And the last 10 years, the American College has specifically created the RICP designation, Retirement Income Certified Professional. And the reason they did this and the underpinning of that designation has to do with the benefits of reverse mortgages, its features, and its importance when it comes to being a part of an overall retirement strategy for seniors. And what I alluded to in my other video is that the amount of information that has been done and researched by individuals that are not pushing the reverse mortgage product on you, and the quality of these people and the level of education on these people is pretty significant. So when somebody raises the point that you wouldn't be taking the mortgage if you had to pay the cash back, and alluding to the point that of the options, this is the worst option, my takeaway becomes this. If I had a pain and I went to the doctor and my doctor was qualified to diagnose it, and that diagnosis required me taking medication to get me well, I wouldn't dismiss the medication that I'm supposed to take to get well because I disagree with the medication or I disagree with the course of treatment. And if I believed in the doctor and his education and his experience and understood that the consequences of not getting the necessary treatment is that I'm not going to get better and possibly worse, then I would really think twice about overtaking and reconsidering my version of what's good for me instead of the diagnosis of the doctor. And that's my polite way of saying, unless your credentials are better than what I'm going to share with you and some of these articles I'm going to discuss with you, that you can access and you have available and you could do research. And that's one of the blessings I said in my last video that we have available, that we have the amount of information that you can not any longer refute what I'm saying. So let me just kind of go here and share with you some of these things, because to me, the value of the education and the value of the information that we have is not about because I say it, because I do reverse mortgages, but let's see who we have to count on. In my last video, I discussed Wade Pfau. If you're not familiar with Wade Pfau, I'm going to allude to a couple of his publications, and if you're interested in retirement and if you're interested in reverse mortgages and you're interested in helping yourself, this is the starting point for you. So who is Wade Pfau? Well, Wade Pfau is a PhD. He's an RICP. Again, he's one of the RICP, and in fact, I think he was involved in creating the RICP, which is the designation of Retirement Income Certified Financials. And he's also a certified financial advisor. He holds a doctorate in economics from Princeton University. He's a professor of retirement income in the PhD program for financial and retirement planning at the American College of Finance. So to me, if Wade Pfau, who just published the third book about Retirement Research's Guide to the Benefits of a Reverse Mortgage, if he can dedicate the third publication of a book entirely to the topic of how a reverse mortgage can be crucial and helpful to you in your retirement, I would listen to him. I would think that, you know what, if I was going to dismiss somebody else, I wouldn't dismiss Wade Pfau, who has his third book and he has a PhD in economics. Here's another article, Hidden Value of Reverse Mortgage Standby Line of Credit, which is what we talked about over here. which talked about the benefit of having a standby line of credit. Again, made by Wade Pfau. Well, Dr. Pfau only doesn't talk about the retirement benefit. He also has two other books. How much can I spend in retirement? This is not a light read. His other book centered around retirement. Safety First, Retirement Planning. Again, by Dr. Pfau. And I'm just not going to leave it at this because for some, more is better. I raised Dr. John Salter last time in my conversation. Well, who's Dr. Salter? He is a certified financial planner, practitioner, and accredited investment fiduciary analyst, which is the highest standard you can have, the fiduciary. Dr. Salter received his PhD in consumer economics with specialization in personal finance planning. He also has earned his master's in personal financial planning, MBA, and BS in chemical engineering. He's an associate professor. Here's one of the articles that Dr. Salter, along with Sean Pfeiffer, who's a PhD and associate professor of finance and personal financial planning at Edinburgh University, along with Harold Davinsky, certified financial planner, research professor of personal finance planning at Texas Tech. In what publication? Journal of Financial Planning. Title, Increasing the Sustainable Withdrawal Rate Using a Standby Reverse Mortgage. Who else do we have? Standby Reverse Mortgage, a risk management tool for retirement distribution. Again, by the same authors. Here's another person that I addressed last time. And I said to you, they're two brothers. Barry Sachs, PhD, JD. Barry Sachs earned his PhD in semiconductor physics from MIT. Taught at Berkeley, he's earned his JD, which is his law degree, from Harvard Law School, and is a certified specialist in taxation law from California Board of Legal Specialization. Which, if you understand that some attorneys are specialized, and that's a different accreditation, it's a higher standard, that's what this gentleman has. After spending 35 years as an ERISA attorney specializing in qualified retirement plan, he used his breadth of skills to discover the role of reverse mortgages to make retirement portfolios last longer. Okay, his brother, which I also mentioned is a PhD, is a professor emeritus at Economic University of Connecticut. Now, the article that the Sachs brother wrote, Reversing the Conventional Wisdom Using Home Equity to Supplement Retirement Income. Here's another article that he wrote, Integrating Home Equity and Retirement Savings Through the Rule of 30. Here's another one, To reduce the risk of retirement portfolio exhaustion, include home equity as a non-correlated asset in portfolio. And these are like 30 pages. This is not like 3 pages and you're done. Here's some other stuff that you could read. Sequence of returns, the serious consequences in retirement. And if you understand what sequence of returns is, and if you read any of Wade Pfau's or any of these other scholars, the most significant impact that the quality of your retirement is going to have is whether in the early years of your retirement, because of market investment loss, you're going to have to tap in and take money out to be able to pay your mortgage, because otherwise you're going to run out of money and you don't have enough savings. So when you go into the savings account and there's not enough money, but you go into your money market and you take your investment money, that money, when the market is down, can never recapture. And that's the concept of sequence of returns. Another article, New York Times got it wrong about reverse mortgage. Jamie Hopkins. Now, Jamie Hopkins has a whole list of credentials. For just brevity's sake, he's one of the designers of the RICP program at the American College, which now again is 10 years old. Is home equity an underutilized retirement asset? Retirement trends, current monetary policy, and the reverse mortgage market. New approaches to finance long-term care costs in retirement. Retirement risk solutions. This is 18 pitfalls of going into retirement and not coming out of it financially sound. When I read the point that you wouldn't be taking the mortgage if you had cash to pay it back, it seems to me that the conversation or the mental thought is there's a better option than a reverse mortgage, and that this is the worst scenario. And if you picked up anything from the last 15 things that I shared with you, and if you go read any of Wade Pfau's books, and you see you understand and see the benefit of the systemic use of a well-coordinated reverse mortgage plan as part of and in conjunction with your retirement, this would never come out of your mouth. And you certainly wouldn't think of it. So now we're moving on to they, meaning the lender, calculate the loan to eat all of the equity and appreciation of the property. I've done a video on this topic of what home equity is, what home appreciation is, and this concept is very crucial because if you think that you're in charge and in control of your home equity, then you have not either looked at it deeper or don't consider the alternative, which is you have zero control over your equity. Your equity comes from two factors. One is paying down your outstanding principal balance, and the other one has to do with your property value appreciation. So when I look at this situation here, and I started off with a $300,000 loan, and let's say my property was worth $600,000, so that's only a 50% loan to value, right? When I pay down this mortgage over time, and assuming I never refinance it and I get it down to zero, over this 30 years, based on your own experience of how long you've had your property for and how much your property has grown in value, if you take this property that's $600,000 and you add 30 years in front of it, what do you think the property value is going to be at that point? Conservatively, would it reach $1.5 million? Let's say it does, which is not a significant amount. You've only paid your property down $300,000 and your property is worth $1.5 million. Now, other than staying in this property and paying your mortgage payments like you're supposed to, did you do anything else for the property to increase in value and to grow? No. Property values did that. But you also understand what? That property values are cyclical. And if you've been in your home for 20 years, you've seen the upward and you've seen the downward. And in neither one of those markets, when it was going up or was it going down, were you in control of the housing equity that you had built? Because the housing equity came through primarily through your appreciation of the property value, not because of your minimal reduction. In fact, when the example that I just used was that every time property values came down and interest values, the interest rates came down, what did people do? They refinanced. Why? Because the housing value appreciated. And when the housing value appreciated, they went in and took out another $100,000, and then they started the cycle over and over again. So when you have a property that has grown in appreciation, you're not in control of that. Now, add that concept that here for the reverse mortgage, what are the three criteria that we look at? Well, we look at the current housing value, we look at what the interest rate of the program is, and we look at the age of the borrower. And now, so if we use the example of the borrower is 75 years old, regardless of which scenario you look at, whether they're borrower type number 1, number 2, or number 3, now you again understand that the amount of time that this person is going to stay in the house, maybe only 10 years, maybe 15 years. Now what's happening to this property value in the 15 years? It's either going up or it's going down. In either case, the question becomes, based on the outstanding loan amount, how much interest is going to be added onto the principal? Well, that depends on the loan amount. That depends on the interest rate. But again, what we do know is that longevity of staying in the house is not going to be prolonged. It's not going to be 30 years. It's going to be substantially less. And because it's going to be substantially less, the amount of equity is going to be less. Now, the other consideration is going to be what? I'm running out of room here, but let me just make it over here, and this is important. When you get a reverse mortgage, the equity portion of the house that's made available to you is not like a traditional forward mortgage where you used to get 80% loan to value, up to 90% loan to value. On a scenario where a person is 80 years old and they have a significant amount of equity, you're looking at typically a maximum of 50% loan to value. And this is really important to understand this, because if you understand that on your current property value, you're going to get typically up to 50%. Now, what happens? Well, it's again different based on which type of a borrower you are. If you're a borrower that at 75 is getting the standby line of credit and has a zero current mortgage, and you get 50% of, let's say, $1 million, which if you throw a stone at a condo in the valley, it's $1 million at this point. Well, if you got $1 million condo or a home and you owe $0 on it right now, there's no way that you're going to eat up all the equity, because you have basically, of the $1 million, you get up to, let's say, a $500,000 line of credit. That line of credit is starting at zero. If you want to pay for the cost of the loan, it's zero. If you want to roll it in, maybe it's $15,000. So you're going to start a line of credit at $500,000 with $15,000. And if you don't need to use that money right away, how much negative equity are you going to build? Minimal. Nothing. Less than a credit card. Now, if you're borrower number 2 and you have a $200,000 existing mortgage and we pay that off, again, that $200,000, what portion of the equity that you're getting, which is a maximum of, let's say, 50%, does this $200,000 represent? Maybe 20%? So if you have 20% of available equity that you're using of your maximum 50%, and your house is worth $1 million, you have 80% of equity left. And again, depending on how old you are and how long you're going to stay in this property, and property values not appreciating, how is it possible for you to completely deplete your equity and be worse off than if you didn't have this mortgage? This equity piece is key, because if you come into this concept of what a reverse mortgage is, and your doomsday thinking is my equity is gone and I'm worse off and there's nothing there, you're going to completely dismiss all of these features and benefits that a reverse mortgage can give you, but most significantly, you're going to completely bypass the fact that you only have a small amount of equity that is within your control, and that has to do with you paying down your loan. The rest of it is housing appreciation. And if you understand housing appreciation and you further understand that the amount of money that your house is going to be available for you to use, then you understand that you're looking at around 50%. So from 50 to 100%, you already have 50% of equity left. And again, depending on which type of borrower you are, you could have 95% of equity from day number one, and you have a reverse mortgage and you have a standby reverse mortgage line of credit. So that's that. The final point that the gentleman made was that there's no exit other than selling and being left broke. This is the doomsday scenario, is like, I might as well just not get it because there's zero options left for me, and if I get this, I'm just basically stuck. So let me talk about this. We've already discussed that on a reverse mortgage, there's no prepayment penalty. You could pay it off, you could sell the house, you could at any time decide to make interest-only payments. And if you conceptually understand that your flight path, your guide to how long you're going to keep the house depends on at what age you get the loan and you move forward, then you also understand that the amount of time that you may have the loan for may be a lot less than what you're used to here, because you're not going to keep it for 30 years. Is it likely? Most likely not. So how much you have in terms of equity, we already talked about. We talked about the fact that of 100% equity, at maximum you're going to get 50. Of that 50, depending on which one of these three you are, you can have up to 95% from the get-go. You can have 20%. You could have 40%. But you didn't use up 100% of your equity. That much we know. And we also know that based on longevity and how long it is, typically it's 7 to 10 years in how long people are keeping a reverse mortgage before they either refinance or sell out of the property. And if there's no prepayment penalty and there's no penalty against making a payment, why couldn't you pay it if you want to do it? Again, I don't recommend it, but to each his own. Another consideration that I want to make, and to just kind of wrap this up, I covered a lot of bases. I feel like I went from A to Z on this, and this is probably the single most informative and longest video that I've done. And I hope that you can excuse my, I guess, disappointment at some of these comments. It comes from a place of passion that I have for this project and this product, because in 20 years of doing mortgages and doing reverse mortgages the last 2 years, I wasn't even familiar with reverse mortgages when I was doing mortgages, because all I was doing was the forward mortgages. And even when I didn't do it, but when I had one of my teammates who specifically did reverse mortgages do a reverse mortgage for my parents 15 years ago at this point, I immediately saw the benefit of it. I understood what it was going to do, and I didn't get caught up on, quite frankly, on any of this. The idea that I'm going to lose equity, the idea that the amortization is going to eat away the home equity, the cost aspect. I didn't concentrate on anything. You know why? I'll tell you why. Because my mindset was, this is the best product for my parents who need to have no mortgage payment, need to have a standby line of credit, and not having to make a mortgage payment when my dad had just gone into retirement and wasn't working, and my mom and my dad were on a Social Security fixed income, was all that mattered to me. And having an available line of credit to use to do as what they needed to improve their quality of life is what mattered to me. I didn't go into it thinking that when they die, how much money is going to be left for me? Is the equity going to be gone? Am I not going to have an inheritance? That wasn't my conversation. That wasn't my state of mind. Because my state of mind was, this is their home. This is their ideal outcome for what they need. And if there's anything left, there's more than enough money for me to have it. And to that point, when my parents got the reverse mortgage 15 years ago, the starting balance was $350,000 and the house appraised for $1 million. 15 years later, when I get statements, the property now has, I think, a mortgage amount of $700,000, so it's doubled in 15 years, and the house is worth $1.2 million, $1.4 million, $1.4 million. So if my mom sold the property today, there's still more than enough to not only pay off the mortgage, and there's still more than enough to leave an inheritance, God forbid she passes away. But again, the point is that you have to come into this program with a different vision, a different perspective. If you come in and all you're thinking is the idea that I'm not making a monthly payment and my equity is being going away, you need to watch this video. If you're thinking that this is the worst option, you need to read some of these books and some of these articles and do some independent research. I don't mean to be upset, and I don't mean to be dismissive of concerns, but anybody who comes at this program from a point of this is a bad program is coming to it from a lack of education, having done the necessary research. Because if this was not a good program, American College, which puts out all these certified financial planners, wouldn't double down and offer a reverse mortgage inclusive program that is designed to help post-retirement through its RICP designation. HUD would pull the program back and make it like it was a mistake, we shouldn't have done it. The only reason that lenders are available and can do this program is because of the fact that HUD has it and FHA supports it, and the United States government buys it. If they didn't think that this is the right choice for seniors at this point in their life, it'd be pulled. Do you think AARP would sit there and say, okay, this is an acceptable product? Absolutely not. So I covered a tremendous amount of information. There is a lot that I digested here for you. And if you go back and you read and you watch and you really think through some of the stuff that we talked about, you will come to see and value the benefit of the reverse mortgage as I do. This is something that I'm really passionate about. And again, I'm sorry if I come across upset, but I don't mean to be. It's just this hits close to home for me, because when I sit across from seniors and I know they're on a fixed income and inflation is at 8% and the cost of living is going up and they lost a spouse and they can't afford to continue making mortgage payments, and they have a substantial amount of equity that they're never going to be able to use. And how would they access it otherwise? They can't access it through a home equity line of credit. They can't afford to qualify. They can't afford to make the monthly payments. And if they did qualify and they used up the line of credit, how would they continue making the monthly payments? If you think through some of these things we've been talking about and look at it objectively, unemotionally, and do the required reading and research, you will have a completely different impression. And if you don't, and you're stuck on a point, reach out to me. I'll do another video. I'll do 10 videos. And that's why I took the time to do this video rather than just basically respond back with comments, because you could see that with the amount of stuff that needed to be covered, I couldn't just respond in comments and say, okay, read this. Because as soon as 3 other people replied, those comments would go down on YouTube and nobody would be able to see them. But through this gentleman's objections, through his concerns, I was able to address fully and break it down individually, so that if you also have this concern and you watch this video and you think about it and you do your own research, I don't think you will anymore. But if you do, reach out to me. I'll do another video and another video and another video, as much as it takes for you to see the big picture and the forest through the trees. I appreciate it. It's time for me to go home on a Friday post-Thanksgiving at 6 o'clock. God bless you. Thank you very much. Thank you for being my client. Thank you for the opportunity to assist you. And I really hope this video helped you. Have a good night.